Hey guys, it's 𝙈𝙀𝙏𝙼𝙀. It is Monday, January 10th, 2022, and this is going to be a breaking news story on both the crashes in the stock and the bond markets. What am I talking about, you may ask? Well, those of you that follow us on the channel know that we talk a lot about macroeconomics in relation to the valuation of gold and silver. And 2022 has started off very, very roughly for both the stock and bond markets. I'll get to the reason why I think it started off roughly, and then I'm going to give you the stats. We have said, basically dating back to the recent Fed meeting minutes and their announcement that they're going to, one, both taper their amount of asset purchases, and two, raise interest rates that would have an adverse effect on the market. Also, we've been documenting high inflation in the system and the indication there's too much money sloshing around for the output. Money creation in the last few years has been much higher than GDP. So we're going to see higher prices. All of those things have come true, and that's causing people to take a serious look at the market. They didn't do it through quarter four because there's euphoria of the holiday season and people making their year-end bets. But now going into January, all the firms, the hedge funds and traders are now looking at positioning for the year, and they have in mind high inflation, Fed taking away the punch bowl. Okay, now we have a story by CNBC that the stock markets are basically entering a severe correction in the first part of 2022. Here it says NASDAQ falls 2%, Dow drops 400 points as Wall Street extends rough start for 2022. This was for yesterday. U.S. stocks fell sharply on Monday, extending a rocky start for 2022 for equity markets as interest rates rise. The Dow Jones Industrial Average dropped 460 points, or 1.3%, and the S&P 500 shed 1.6%, and the NASDAQ Composite slid 2.3%. The S&P 500 and NASDAQ Composite are both coming off 4 straight days of losses, while the Dow has retreated in 3 consecutive sessions. I'm reading from a CNBC story that's on their website today. The rough start for stocks this year has come as interest rates have spiked. The benchmark 10-year Treasury yield briefly traded above 1.8% on Monday morning after ending the year on 1.51%, and I'll explain why that number by itself is not a good indicator of the health of the bond market. We'll get to that in a moment. On Sunday, Goldman Sachs projected the Federal Reserve to hike rates 4 times in 2022, signaling Wall Street increasingly expects the central bank to get aggressive in an attempt to curb inflation. However, some Fed members have said in recent meeting minutes they may not raise interest rates as much, but instead they may seek to change their balance sheet with respect to how much debt that they have. In other words, not only would they taper down to 0 additional asset purchases, the central bank, but they may actually start selling off. And so we're not sure 100% if they're actually going to raise interest rates. But so we're a little bit mixed on what the Fed's going to do, but they're definitely getting more restrictive. Large tech stocks were under pressure in early trading. Shares of Facebook, parent Meta, and chipmaker NVIDIA falling more than 4%, and Amazon dropping 3%. And what the article goes on to say is that tech has been weak this year, but people aren't putting the money into other things. In other words, the indication or the intimation from the article was that people are just pulling out of the stock market net overall. And as if that's not enough, I have some good data here for you on the bond markets. Now, the yield is basically a combination of price and interest rate. A lot of people mix up the yield and interest rate, but really the true yield is what is the price of the bond and what is interest rate. You have to look at both to know your true yield so you can compare period over period. What does that mean? Well, if you think about bonds, the prices of bonds are inversely correlated to interest rates. So if interest rates go up, that means for people to buy an older bond with a lower interest rate, the price of that older bond has to fall. So as interest rates move up, the actual face price of a bond has to fall. But the overall value of that bond issuance can also change over time relative to previous issuances if people see more risk. And that's exactly what we're happening. And that's the total yield in a bond is what is the best metric is total return. It's both price change and the level of yields or accrued interest for that bond. And so we're going to talk about the 30-year. Dating back to 1973, last week was the worst calendar week in total return in the 30-year bond market dating back to 1973. That's 49 years of data. The long bond has lost 9.35%. And that was last week. If it were a year, 9.35% would be in the 5-year worst ever. So it's pretty epic as far as bonds go. When you talk about interest rates and the total value of the bond, and again, that's gonna do the price change and the level of yields. You can take both into account. This is the worst week in 49 years. And that week would have been, if you extrapolated to a year, it would have been one of the worst 5-year periods in history. The 10-year didn't do much better. It had its worst week in 42 years with a total return loss of 4.24%. Only February 1980 saw a bigger loss for the calendar week, and that was the inflation panic and Volcker and raising interest rates very quickly. So the 10-year had its worst in 42 years, excepting February 1980, when you had that interest rate spike and the panic in the markets, and Volcker basically trying to save the system. The 10-year TIPS, Treasury Inflation Protected Securities Index, was negative 6.09%. This is the third worst week ever in recorded history. So essentially the 30-year, the 10-year, and the inflation protected debt issuances by the Treasury have seen their worst, basically worst performance last week of 40 years. When you consider both the prices of the bonds and the interest rates to get total yield. So when you guys are looking at the bond market, don't just look at, is it 10-year trading at 1.81 versus 2%? Also look at the prices, because the prices can change independent of the interest rates. Higher interest rates drive lower prices and vice versa, but the prices can change independent of just the interest rates. If people are looking at the totality of the market and saying, I don't really like this market very much, okay? And so in a period of high inflation, we're seeing in 2022, the market start to revalue tech stocks, the broader stock market, and bonds in the US, and we said this would happen. They're anticipating the Fed taking away the punch bowl, and it's already hitting the markets right now. The Fed hasn't actually done anything yet. Can you guys imagine what's going to happen when the Fed does something? That's going to be massive. Breaking news, great data I gave here for you guys to follow the market, because that's what we do on our breaking news segments, and we're going to continue to do that. We just had, I'm still here in the hotel in Denver. We had a great event Saturday night in Denver. For those of you who didn't know, we teamed up with Economic Ninja, Wall Street Silver, Hearsay Financial, Financial Fitness, Nobody Special Finance, to do a special meet and greet at a local bar here in Denver. It was a smashing success. We've got some video from that and some pictures we'll put up on the channel this week. I think we're going to do another one. Stay tuned for that. It's going to be a lot of fun. But as I get ready to leave the hotel, check out, and go back to the airport, I wanted to get this breaking story out to you guys. Remember what we said last year. We expected pressure to come on the stock and bond markets because of inflation and Fed policy. Okay, and the amount of money printed in 2020. And that's exactly what's happened. We'll continue to follow it for you guys. Until next time, this is Rob Kienzl, goldsilverpros.com.